Welcome to the Deep Dive. We're your shortcut to getting genuinely well-informed. We pack in surprising facts, maybe a bit of humor, hopefully just enough to keep you hooked. What we do is take a whole stack of source materials, articles, research, our own notes, and boil it all down to the really important stuff for you. Today we're plunging into something pretty significant, actually. It's about how organizations measure and report performance. And it tackles this fundamental question. How do you really measure the health, the long-term viability of a business when, the traditional financial numbers, they only tell part of the story? We're diving into the world of integrated reporting, or IR.
That's right. And our mission for this deep dive is really to unpack what integrated reporting actually is, why it's becoming so relevant now in today's, let's face it, complex business world, and crucially, the practical side. What are the implications, the challenges it presents for how organizations assess, their overall performance and maybe more broadly, their value creation? It's a shift in mindset, really, as much as it's a reporting framework.
And we're basing our insights today on a really great article that lays out these core ideas and sheds light on some of the real-world hurdles. So settle in. This could genuinely reshape how you think about organizational value. Okay, let's unpack this. Yeah. So to kick us off then, it seems pretty clear performance reporting's been, evolving for decades, hasn't it? We've definitely moved beyond just the pure financial numbers. There's this growing recognition that non-financial stuff is absolutely crucial. I mean, think about established systems like the balanced scorecard, those multidimensional approaches. But where does integrated reporting fit in? What's its unique contribution here?
Yeah, it absolutely builds on those developments, but it really takes it a step further. Integrated reporting, IR, it aims to provide a much more sort of holistic view of the value an organization creates. And not just for its shareholders, mind you, but for all stakeholders. It's broader. It's about looking beyond, say, the quarterly financial statement and considering all kinds of resources, the tangible stuff, sure, but also the intangibles. And critically, adopting a much longer-term perspective on how value is generated. What's really fascinating here is how IR tries to illuminate an organization's entire business model. It explicitly shows how the organization draws on a range of different capitals as inputs. These could be funds, obviously, or physical assets, knowledge, people, relationships, even natural resources. Then it details how these inputs get transformed through operations into outputs, products, services, or even waste and pollution. That's an output too. And ultimately, this all leads to wider outcomes, things like staff development, maybe environmental regeneration. It's genuinely a full circle view, trying to capture how value is created and, importantly, sustained over time.
That makes a lot of sense, actually, connecting those dots, inputs, operations, outputs, outcomes. And speaking of those capitals you mentioned, this is where it gets really interesting, I think. The International Integrated Reporting Council, the IIRC, they identify these as the building blocks for value creation. Can you walk us through what those 6 core categories are and why they're so, foundational to this new way of thinking?
Absolutely. Yeah, understanding these 6 capital is pretty central to getting integrated reporting. Let's break them down. First up, financial capital. No surprise here. This is the traditional pool of funds, debt, equity, grants, cash generated from operations investments. It's the money that fuels everything else. Next, manufactured capital. These are the physical things. Buildings, machinery, equipment, infrastructure, roads, ports, that sort of thing. Basically, the tools and structures that let an organization operate. Then we've got intellectual capital. Now, this is about organizational knowledge-based intangibles. Think patents, copyrights, but also organizational capital like the hidden knowledge, the systems, procedures, the brand, reputation. It's the company's collective brain power, its unique know-how. Then, human capital. This is all about people, their individual skills, their competencies, capabilities, experience, and their motivation too. How aligned are they with the strategy? Are they loyal? Can they innovate, lead? That's what makes a company dynamic, right? Fifth is social and relationship capital. This covers the institutions and, crucially, the relationships an organization builds within communities, between stakeholders, shared norms, trust with customers and suppliers, partners, even its social license to operate, basically. Does the community and do regulators approve? It's the glue for the external network.
Right, the trust factor.
Exactly. And finally, natural capital. This includes all environmental stocks, renewable and non-renewable. Air, water, land, forests, minerals, biodiversity, everything that provides goods and services from the environment. And here's the interesting bit, maybe the kicker. Companies are really starting to get that, neglecting this. It isn't just bad PR. It's a direct threat to their long-term financial health.
Yeah, you hear that more and more.
Think about climate change hitting supply chains, or water scarcity impacting manufacturing. It's moving beyond, just greenwashing towards core business strategy. Recognizing natural resources are finite and absolutely critical.
That's a remarkably comprehensive list. Wow. And the source clarifies something interesting. It says, while intellectual, human, and social and relationship capitals are clearly related, the IRC makes a point of distinguishing them. Can you elaborate on that? Because, on the surface, they seem pretty intertwined.
Oh, they absolutely are intertwined, deeply so. And that's kind of the challenge, but also the beauty of integrated thinking, isn't it? The IRC gets that they're interdependent, but argues they're distinct enough to be treated separately for reporting. A helpful way the source suggests differentiating them is by thinking about the carrier of each capital.
Okay, the carrier.
Yeah. So for human capital, the carrier is the individual person. Their skills, their knowledge reside in them. For social and relationship capital, the carrier is the networks between people, between organizations. It's about the connections. And for intellectual capital, the carrier is the organization itself, the systems, the patents, the brand equity that belongs to the company. So yes, they influence each other massively, but they kind of originate or are embodied differently.
Okay. That carrier idea clarifies it perfectly.
Yeah.
So these capitals, they're the foundation for value creation, but they're not standalone silos. They're profoundly interconnected.
Profoundly, yes. Like a complex ecosystem, really. The source uses a simple example. An organization buys new equipment. Okay, straight away, financial capital goes down. You spent money, but simultaneously, manufactured capital goes up. You have a new machine. The expectation, obviously, is that the increased efficiency or productivity from that machine will, over time, more than make up for the initial financial hit. So it adds overall value. What's really crucial here is understanding how building up, or conversely, running down certain capitals affects everything else, especially those in limited supply, think skilled staff, that's human capital or non-renewable ones like fossil fuels, which is natural capital. Depleting those can seriously impact an organization's long-term viability, its ability to keep creating value. This whole view encourages what the IRC calls integrated thinking.
Integrated thinking.
Yeah, basically management understanding these deep interconnections between functions, operations, resources, relationships, everything that contributes to long-term value. It's really about breaking down those internal silos and seeing the whole picture, Now, for integrated reporting to be, actually useful for making decisions, for control, organizations really need a practical way to measure performance in these key capital areas.
Okay, this sounds amazing in theory, but I'm imagining the challenge. Measuring something as intangible as human capital or social and relationship capital. That must be immense. How do companies even start to quantify that? Especially when, as you mentioned, the IRC itself says some aspects are, best reported in narrative, not metrics.
That is the million-dollar question, isn't it? And you've absolutely hit on a critical point. While quantitative indicators, what we typically call KPIs, key performance indicators, are important, it's just not practical, maybe not even possible, to quantify every single aspect. The key word here is materiality.
Materiality, okay.
When you're selecting performance measures, the focus has got to be on information that is material to stakeholders. What do they actually need to assess the business? This isn't about measuring absolutely everything under the sun. It's about identifying the truly critical success factors, the CSFs, and then picking a relatively small number of KPIs that genuinely reflect performance against those specific factors. It's an approach that should be familiar, really, from strategic planning focus on what truly drives success and risk.
So the management accountant's role here becomes, almost like a strategic architect, working closely with leadership to pinpoint those critical business issues and then figuring out the KPIs that really capture the essence of performance for each capital. It's definitely a shift from just number crunching to providing strategic insight.
Exactly right. Let's use that worked example from the source, Zaccair, the airline. That makes it more concrete for you listening. So Zaccair wants to adopt integrated reporting. They need to include info on fuel efficiency and safety. Okay, first, fuel efficiency, where does that fit? Well, it should be classified under natural capital.
Natural, okay, makes sense.
Why? Because it relates directly to how efficiently Zaccair uses non-renewable resources oil for jet fuel. It also impacts outputs, right? Reducing CO2 emissions. An appropriate KPI here, something like kilometers flown per gallon of fuel. And the per kilometer part is crucial because flights obviously vary hugely in length. Just measuring fuel used per flight wouldn't tell you much about efficiency, just how much fuel a particular route burned. Plus, increasing fuel efficiency clearly helps Zaccair's financial capital too by cutting costs. So you see that in a relationship again.
Yeah, clear link.
Okay, then there's safety. This should probably be classified under social and relationship capital.
Social and relationship, why that one?
Well, think about it. Zaccair's safety record directly impacts customer trust, their willingness to fly with them, that's a relationship. It also affects their ability to keep their operating license from regulators, that's a direct relationship with a key stakeholder, involves trust and compliance. An appropriate measure here could be the number of accidents and safety incidents in the last 12 months.
Well,
Now, fatal crashes, thankfully, are rare, so just reporting crashes might show 0 most years, which isn't very informative day to day. A more insightful metric would include safety incidents, things like near misses, losses of control, stuff that could have led to an accident but didn't. That gives a much more proactive view of risk management. So, at its heart, integrated reporting is really aiming to promote decision-making that supports sustainable value creation. Not just short-term wins, but value over the medium and longer term. It's kind of a direct response to that short-sighted thinking that can, burn through valuable resources just for a quick profit.
and that has massive implications, doesn't it? It means organizations can't just chase quarterly profits if it means damaging other capitals, like, say, neglecting customer relations, your social capital, because that's ultimately going to hurt long-term value creation down the line. It feels like a much more balanced, almost philosophical shift in defining corporate success.
It absolutely is. And it means performance metrics have got to address these different capitals. They need to give insight into that longer-term value creation. Forget just annual profits as the sole benchmark. A really key consequence of IR is this increased reliance on non-financial data. You need it to get that clearer, more holistic picture of performance across all the capitals. It also encourages paying more attention to non-financial data in big strategic decisions. Things like investment appraisals might need to explicitly include non-financial costs and benefits, sustainability impacts, right alongside the traditional financial numbers. It's really about making the invisible visible.
So this all sounds incredibly powerful in theory, a really visionary approach, you could say. But for companies listening, the big question surely is, okay, how on earth do we do this? How do you implement something so far-reaching? What are the real practical challenges organizations and their management accountants face when they try to make IR a reality?
Yeah, you've definitely hit on the core practical dilemma there. The source highlights several pretty significant hurdles, especially for information systems and for the accountants trying to pull these reports together. First big one, data availability.
Right. Can you even get the data?
Exactly. Can existing IT systems supply the necessary data, especially for those non-financial capitals? Human, social, natural. The answer for many companies is probably a resounding no. Not easily, anyway. This often means a significant, potentially costly overhaul of legacy data collection processes, or even building completely new systems from scratch. That's not a small undertaking.
No, definitely not trivial. What else?
Second major issue is consistency and comparability. Unlike financial data, which usually has standardized definitions thanks to accounting standards, non-financial data can be really tricky. How do you make sure it's reliable, consistently defined? Think about defining employee engagement or brand reputation. How do you measure that consistently across different departments, different countries, let alone compare it with other organizations?
Yeah, that's tough.
It makes comparing performance over time within the same organization difficult, let alone benchmarking against competitors.
Okay, so data availability, consistency. And if that wasn't enough, the source points to what might be the biggest hurdle of all, connectivity. It's not just reporting on each capital separately, is it? It's showing how they all link together, those intricate webs of interrelationships. What makes that specific challenge so formidable?
It's formidable precisely because it demands that integrated thinking we talked about actually becomes integrated doing, integrated action. Most companies are still pretty siloed, right? Different departments manage different capitals, often using completely different systems, different metrics.
Yeah, finance talks finance, HR talks people.
Exactly. So showing the interrelationships, the dependencies between all these factors and capitals, to give that truly holistic picture, it demands breaking down those internal walls. Fundamentally changing how data is collected, yes, but also how it's shared, analyzed, and understood across the entire organization. It's not just a technical IT challenge, it's a deep cultural one. It requires departments to collaborate in totally new ways. And let's be honest, that kind of fundamental organizational change is rarely easy or quick.
Okay, so to kind of wrap up our deep dive today, the core idea behind integrated reporting, it's really about broadening our definition of value, isn't it? Moving way beyond just the financial numbers, acknowledging that a company's true worth, its long-term health, is far more complex.
Absolutely. And what's fascinating here, I think, is how IR fundamentally pushes organizations to think holistically, about all their resources, all their relationships, and crucially understanding that they are incredibly interconnected. It's about seeing that bigger picture of how value is genuinely created and sustained. Moving beyond just counting the dollars and cents to recognizing the real value in people, in knowledge and relationships, and yes, even in the environment itself.
So what does this all mean for you listening? What stands out to you about this broader perspective on organizational value? Does it resonate?
Yeah, here's a thought to leave you with. Consider an organization you know well, maybe where you work or one you invest in or just one you follow. How might their value creation story look different if you viewed it through the lens of these 6 capitals, rather than just looking at their financial statements? You might just discover some hidden strengths or perhaps some hidden vulnerabilities you never really considered before.
And with that thought, we encourage you to keep exploring how these different types of value are created, measured, and reported in the world around you. Thanks for joining us on The Deep Dive.